Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent CPI report. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. That sale is going to end by the end of the weekend. Okay, let's go ahead and jump in. This is a really interesting inflation report, and we're going to try to break it down to fully understand what's going on. There's a lot of implications of this inflation report, and I also want to talk about the impacts of inflation on Bitcoin. So, one of the things that we've talked a lot about is if the Fed cuts too soon, it could lead to another wave of inflation, like we saw in the 1970s. If they don't cut soon enough, right? If they wait too long, then you could get a deflationary crash, which is exactly what happened in 1949, right? This white line here is United States headline inflation, and this is roughly around zero. And you can see there was a deflationary crash. We also saw a deflationary crash during the financial crisis, right? So it does sometimes happen. Now, it's easy to compare to the 1970s. It's easy to compare to the 1940s. The reality is that this cycle will probably not look like the 1970s, and it probably won't look like the 1940s. You know why? Because it's going to look like the 2020s. That's the fact of the whole situation, is that it's not going to mimic either of those two outcomes. It'll probably be something in between, is my guess. Now, one of the things that we've mentioned is that inflation had fallen back to just under 3%. Now we just got a reading of 2.59%. So it's great reading. I'm sure Powell's going to be pleased to see that. But for a long time, inflation was stuck right above 3% or very slightly below it. And because of that, because it had been stuck just below 3%, but it wasn't really falling, you had to at least make the comparison to the 1970s, where in the summer of the election year, we got the August 1972 report, which is what we just got, August 2024. Headline inflation came in still at 2.9%, and then it started to go back up as the Fed loosened up policy. Now, I have said many times that I don't think this is exactly like this, and one of the reasons is because in 1972, right, if you were to go back over here to 1972 and look to see when inflation was sort of sub 3%, the unemployment rate was actually going down during that time, right? So the labor market was tightening up. But now the unemployment rate is going up, meaning the labor market is softening up, which should help put downward pressure on wage inflation. So this type of a move to 2.59% or so is welcome. It's welcome because it helps us to, at least for the time being, deviate from what happened in the 1970s. That doesn't mean you can't get a second wave of inflation. At some point during this decade, we probably will, but it might not be as bad as what we saw in the 1970s. So that's at least welcome news. But we also know what happens when the Fed waits too long. And that's what happened. That's what we saw back in the 1940s, where we had a deflationary crash. Again, just like we saw during the financial crisis, we also got a deflationary crash in the mid-1950s. So it's interesting to make these comparisons. The reason I make the comparison about the 1970s and the 1940s is that we had high inflation. The 1970s, we had 3 waves of inflation. The 1940s was coming out of World War II, where there's a lot of money printing to finance the war. So you could argue that it makes sense to compare it to both, but it's probably going to play out differently than either of those prior two outcomes. So going back to headline inflation, this is a great number, right? 2.59%. And, I've been in the camp for a long time that they're likely just going to cut 25 basis points the very first meeting. The reason is because if they cut 50, that might actually send more of a warning signal to the markets that, hey, perhaps they've waited too long. They don't normally kickstart, interest rate reductions with 50 basis point rate cuts. It might imply that something's wrong. Whether it is or not might not matter. So my guess is that they're going to go with 25 basis points. Be that as it may, I was thinking when I first saw this report of 2.5%, my initial thought was, oh, maybe the markets will start to price in a 50 basis point rate cut, or at least a higher probability of it. But in fact, markets are saying, no, 87% chance that the Fed's going to cut 25 basis points, which probably makes sense, right? I mean, again, I'm in that camp that it's going to likely be 25 basis points. That does not mean the Fed can't ramp it up from there. For instance, if you go look at the probabilities for future rate cuts, after a 25 basis point rate cut in, for the next month or two, the markets are still potentially expecting a 50 basis point rate cut at some point this year. So you might get one. It just might not be for that very first meeting. And then I was wondering, well, why is the probability still so low? And when you dig into this stuff, it makes a little bit more sense. One of the reasons that the Fed is likely just going to go with 25 basis points is because of core inflation, right? If you go look at core inflation, it actually went slightly up this past month, okay? And so that is still a ways off from, durably going back to 2%. I mean, it probably will eventually, but that's not the data point you would want to see, right? I mean, it could just simply be something like this, where it goes up for a single month and then resumes the downtrend. But let's suppose the Fed cuts 50 basis points and then core inflation continues to go back up. Then the Fed might look back and think they made a mistake. And so it probably makes more sense to ease into the rate cut part of the cycle, especially considering that core inflation has not gone below 3%. Yeah, this entire business, during this entire downturn in core inflation has not gone below 3%. But the other interesting thing about headline inflation is, when I first saw this number, I was expecting a big drop in housing or something like that, right? Because if you go look at the inflation year over year per category, if you look at it per category, you will notice that, let's look at all of them, right? So here's headline inflation. A nice drop here. It was great to see. Look at the monthly change. Pretty nice drop, right? Negative 0.332%. That's actually the largest drop in headline inflation that we've seen since October of 2023. So that's a great thing to see. But if you go through the categories, it doesn't really paint the picture that you might have expected. For instance, food and beverage inflation dropped a little bit. Housing actually went up from 4.33% to 4.44%. The reason that's a little interesting is if you look at the inflation year-over-year contributions per category, because again, they're not actually weighted the same. Housing contributes like 2/3 of it right now, right? So if you look at headline inflation is 2.59, housing is 1.93 of the 2.59. So it's more than 2/3 of headline inflation is just simply coming from housing. So when I first saw the 2.5 number, I'm like, oh, that must mean there was a big drop with housing. And then I went over here, I was like, oh, housing actually went up. So I was like, well, where the hell did it come from? Right? Where's the drop coming from to 2.5%? If it didn't come from food and beverages dropped a little, but not much. So if it didn't come from food and beverage, it didn't come from housing. Did it come from apparel? No. That also went up. Okay, so you have to keep going through the categories. Look at other goods and services. That dropped by about 0.2%. Education and communication actually went up, but it's still well below 2%, so it's still not that concerning. Recreation also went up. So I'm kind of scratching my head about it. I'm like, what's going on? Medical care went down a little bit. But one of the bigger contributions to why it went down was transportation, because transportation has gone deflationary again, right? Total headline inflation is still inflationary, but there are components that have gone deflationary. Transportation is notorious for occasionally going deflationary. If you look at the larger map, you can see it's no stranger to it. And it's gone deflationary during, fairly economic prosperous times. So the reason why transportation had the effect is because it's weighted more than a lot of the other categories. Not as much as housing, but if you were to look at some of the weights here, like food and beverage is pretty small, right? It's about 10% of it or so. If you look at again, here's housing, it's like 2/3 of it, more than 2/3. Apparel, basically nothing, right? You'd have to squint to see the contribution. Medical care, not a lot, right? It went from 253 to 238. Not a huge contribution there, change. Recreation, relatively low. Education and communication, relatively low. Other goods and services, again, relatively low. So the main thing that changed was transportation, because last month it contributed 0.186 of the 2.92, so almost 0.2, right? But this month it contributed negative 0.12, right? Negative 0.12. So it's like a 0.3 swing. So that is one of the main reasons, right? I mean, if you subtract 0.2 from that, right? I mean, you basically get negative. You already get negative, and you can see it went negative by another tenth or so. So that, I think, I mean, if you just look at the data like I am here, it looks like that's where a majority of this is coming from, is from transportation's effect. Because as I showed, it's not really coming from housing. Housing went up. And while food and beverages also dropped a little bit, again, the contribution didn't really change a whole lot. Apparel, you have to squint to see. A lot of these you'd have to squint to see. So it's really just that drop in transportation, which helps so much. So because of that, right, because you're not yet still seeing it across the board, it's going to make sense, I think, for the Fed to just ease into this with a simple 25 basis point rate cut. Because if they do too much, then you still run the risk of repeating the 1970s, which again is not my base case, because the unemployment rate's going up right now as opposed to down like it was in the in 1972. So it's really interesting to look at the market through that lens. Now, the reason why the Fed should probably start cutting is because if you were to look, I mean, here's inflation overlaid with the unemployment rate. But what I'd like to do is I'd like to look at interest rates really quick, right? So let's look at interest rates. And what you'll notice here is that interest rates have been at about 5.5% for over a year, right? This is like month 13 or so since the Fed really paused rates, right? If you just take a date range here, 12 months or so, right? 12 months. I mean, really, it's September, and that only went out till August. So that's why, I mean, it has been 13 months. But you guys get it. I mean, it's been about over a year. But when you think about it, what is the real rate? Because 5.5%, right? If you're in a T-bill or a CD, right? If you're in a fixed income investment and you're earning 5.5%, you're not really earning 5.5%. You're earning the Fed funds rate minus inflation. Okay. Now, I get it. I know a lot of you guys are, you're going to get your pitchfork out and you're going to say, well, you can't trust the numbers. Guys, let's just get beyond that. Okay. I'm not arguing whether you can trust them or not. What I'm arguing is that the Fed bases their decisions on this stuff. So it doesn't matter whether you think they're valid or not. This is what leads to different reaction functions by the Federal Reserve. So if you need to get out of your system, you can get out of your system and put it in the comments below. But that's neither here nor there in trying to figure out what the Fed's reaction is actually going to be. So when we think about the risk-free rate, right? If you want to go out and earn a return relatively risk-free in, say, like a T-bill, you're earning 5.5%. Okay, but let's say, or you could be earning 5.5%. It depends on the length, right? But let's just say you want to know your real return, meaning out if you subtract out inflation. Now, again, some people are going to say, oh, well, inflation is really much higher. Get it out of your system. Take that to another channel that cares. Okay, I don't care about that. You have to look at interest rates minus inflation. So when you do that, right, when you take U.S. interest rates minus the U.S. inflation rate year over year, you get something that looks like this. What do you notice about this? It's starting to go up pretty quickly here. The reason is because the Fed funds rate has stayed constant, but inflation has gone down. So it's now at 3%, right? Your real return for a fixed income investment earning 5.5% is actually 3%. That might sound low, and it kind of is, but it's higher than it has been for a while, right? The Fed, if the Fed wanted to get back to the level of restrictiveness that they were at, say back in, a year ago, right? September 2023, they would have to cut 125 basis points, because you can see back then the real rate was about 1.75%. Again, interest rates minus inflation. But now the real rate is 3%. So in order for the Fed to just get back to where they were a year ago when they stopped raising rates, they would need to cut 125 basis points. So you see how the business cycle goes, right? The issue is, let's suppose they cut 25 basis points. But then let's suppose that inflation comes in next month at, I don't know, 2.2%. Then this could actually still go up if the Fed's cutting at a less aggressive pace than inflation is going down. So that is why you can get to parts of the cycle where the Fed starts to cut more aggressively than most people think, right? So when you look at the Fed funds rate and you look at likely outcomes, right now it's kind of all over the place. But a lot of times you'll see, you would just see a systematic 25 basis point rate cut at each meeting. We've seen that for a long, long time. And some people say, well, how is this possible? Like, the Fed doesn't normally just cut 25 and then 25 and then 25 forever, right? They cut a little bit. And then if the economy, basically goes into a recession, then they cut a lot. And if the economy doesn't go into a recession, they stop cutting. So how can you get something where it's just a steady cut? I've said this before. What you're seeing on this table, in my opinion, is a bimodal distribution where some traders are pricing in aggressive rate cuts, where in a year, the Fed funds rate is 2.25, right? But then other investors are pricing in a soft landing, or maybe even no landing, where that doesn't happen. And so the results that you get on this page just are something in between, right? This outcome that you see right here is likely not what's going to happen. It's probably going to be something different. But if you take both opinions, if you take both extremes, and then you put those traders together in a prediction market, then you get something in between. So that's why I say it's more of a bimodal distribution where there's two likely outcomes, and traders are placing their bets on which of those outcomes is more likely, and then therefore the actual probabilities are something in between those two outcomes, right? Because one outcome is that the Fed just cuts to, say, 4% and they stop there. Another outcome could be they cut to 2% and they stop there. But again, it could be somewhere in between. My guess, right, since you're here on my channel, you probably want to know my opinion. I've said it before, but my guess is that the Fed funds rate, unless we go into a deep recession, right, the Fed funds rate, I'm guessing, is going to go back down to around 3 to 4%. Right? It's kind of convenient because I've said ETH Bitcoin to 0.03 to 0.04. Now I can say the Fed funds rate to 3 to 4%. Right? Not the real rate, because the real rate's already at 3%. I'm talking about just the if you take it back down, right? If the Fed funds rate goes down, how low could it go? I'm thinking 3 to 4%. If you get a hard landing, it could go lower. Absolutely, it could go lower if you get a hard landing. But again, timing is everything, and if you get a hard landing, it's hard to know exactly when that's going to be. So going back to this chart, this is the highest real rates have been since 2007. You can see this. And what's interesting is when you look at the real rates, you can generally see that it's been in a downtrend for a long time. I'm sure some of you might be tempted to do some technical analysis on a chart such as this. But the point, right, the general point here is that the trend of real rates has been going down since 1981. And now you're potentially starting to see it go back the other way. Now, it could do something like this, right, where it just sort of, does something like this where it just oscillates in that range rather than go onto a steady path higher. But it looks like it's potentially turning around for a little while. The last time we saw real rates drop this low, at least with the data we have, is not at least since the 1970s. Because even in the 1970s, real rates were not that low. -8% in April of 2022. It shows you just how far behind the curve the Fed was. I mean, the Fed was so far behind the curve that real rates were negative 8%. Even when inflation was, you know, what was it back in the 1970s? Like 15% or something crazy. 15%, right? Even when it was 15%, the real rate was nowhere near that. And the reason was because the Fed didn't wait so long to start cutting. It's still, I mean, it's somewhat baffling that they did wait this long. But again, it's easy to be the armchair economist and criticize when most of us, if we had been in charge of the Fed, we probably would have made 1,000 mistakes. So again, I would implore you not to do that. It's easy to point fingers after it's all said and done. But the reality is when in February 2022, real rates were at negative 8%. And the only other times in history where, at least in recent history, where we saw something like that happen was back over here in 1975 and in 1980. Now, Powell has said many times that he does not want to repeat the mistakes from the 1970s. You know, with Burns and basically just getting all these waves of inflation, he'd prefer, I guess, the path of Volcker, where they actually got inflation under control. And you can see that this looks somewhat similar to what we saw back over here in the 1980s. However, you could also argue that it still looks somewhat similar to what we saw in 1973. So it still might be premature to completely take off the 1970 view from the outlook. It could be premature. Because real rates right here, 3%, you can see that over here in 1972, 1973, they wicked up and then they came back down and then they had to go back up again. So if you were to overlay the US inflation rate year over year onto this chart, you'll see that inflation, right, it went up and then it came back down. And then it went up and then it came back down, right? So it went up here and then it came back down. So the issue is if the Fed pivots too soon, and the only reason inflation came in at 2.5% was because of transportation and housing starts to go back up, then maybe it is a repeat of the 1970s. Again, my base case is that it's not, because my base case is the unemployment rate continues to slowly go higher, and that they will go as long as they have to make sure the job is complete. The nice thing about the 1980s is once it was complete, then we had basically a full decade of economic expansion. The problem with the 1970s is that they pivoted too soon, right? They pivoted too soon. And what ended up happening was the S&P just kept on putting in higher highs and lower lows for the better part of a decade, right? And no one really wants that, right? No one really wants that. It'd be better to get this over with so we don't have to worry about it later as much. Like you can see, like in the 1970s, it was a series of slightly higher highs and then slightly lower lows, right? And that would be a very painful path, right? And we've talked about this before. I hope that's not the path we take, because if it is, it's just going to be a really boring decade. And back then, the S&P increased 15% above its prior high. And if you look over here, it went up about 15% above the prior high. So, I don't know. Is this the beginning of that again? Hopefully not, right? As it relates to Bitcoin, which I'm sure people are interested in, as it relates to Bitcoin, it's kind of eerie because Bitcoin did poke its head above the prior highs. And I'm like, well, is it? Is it just doing something like that where it's a slightly higher high? It's a possibility. Again, it's hard to say. One of the things that I think about, and I've shown this before, is when you take the S&P divided by the unemployment rate squared, multiplied by U.S. interest rates, multiplied by U.S. inflation rate year over year. When you do that, you get a chart that looks like this. And it pretty clearly shows all these bubbles that have formed throughout the decades. And then I'm like, what's going on here? Is this just a larger one than we've seen? But if you think about it, this will likely quickly come back down here. The way it could go back down there is if the unemployment rate keeps going up and you keep dividing by that number squared, then this number is going to go down. And we're multiplying by inflation, which is going down. And we're multiplying by interest rates, which are likely going to start going down. So this chart will likely continue trending down. Even if the S&P goes sideways, this chart could go down. Because it seems like all the other three metrics are going in the direction that they would need to make this chart ultimately go down. That doesn't mean the S&P can't go higher, right? Anything's possible. And in fact, some of the, in the 1970s, the S&P often topped out in December of the election year. In the 1940s, it topped out in the summer of the election year. And so far this time, the all-time high is in July. Right? It's in July. So, when I look at these inflation charts, I say, look, it's welcome news that inflation has dropped to 2.59%. That's absolutely terrific. Core inflation, we still have some work to do. I think it makes absolute sense for the Fed to just only do 25 basis points, get another data point, right? If you go look at the meetings, they're gonna cut next week. So then we'll get October inflation. Not only will we get October inflation and October unemployment, but we'll also get November unemployment, I believe, before the Fed has to make another decision. And they might get a nod as to what inflation might be, and because Powell has previously said sometimes they will get the number in advance, just in advance, especially if they're about to make a big policy decision. So that seems the most likely path, right? Cut 25 basis points, get more data over the next couple of months, make sure it's not the 1970s. Should be pretty simple to do, right? If inflation goes to, say, 2.3% or something like that, the next couple of months, then it's pretty clearly not the 1970s. And it's already pretty clearly not that, considering unemployment's going up, while in 1972 it was actually going down. So really interesting way to view the market. As far as Bitcoin goes, as I've said previously, it's likely just going to keep absorbing that liquidity from the rest of the market. One of the interesting things I was looking at, two things. 2-week candles have been kind of interesting for Bitcoin for a while, because it's like, you get a big green one and then a red one that takes out, sort of like an engulfing candle, right? It completely takes out the green candle. And then you get another green 2-week candle and then a red one where it engulfs it and goes down. And now we've just started another 2-week candle. What's interesting is that this 2-week candle will end right after the Fed cuts rates. And last cycle for Bitcoin, it was right after the Fed cut that Bitcoin then got another drop. Now, you should know that the Bitcoin might not follow it in terms of that particular outcome. Like, it might not do the exact same thing it did back in 2019 as it relates to rate cuts. I'm somewhat torn. From a time-based perspective, if I didn't know anything about sort of the macro side of things, and you just looked at the chart, you would simply say, well, this downturn lasted about 6 months. And this one also lasted about 6 months. So why does it need to keep going on? Right? That's one way to think about it. The other way to think about it is to say, well, the drop to the 100-week moving average didn't even occur until after the Fed cut rates, right? Until after. And you can see that the last 2 cycles, Bitcoin fell to its 100-week moving average. Last cycle, Bitcoin fell to the 100-week after the Fed cut rates. The Fed cut rates, like right here, and then shortly thereafter, Bitcoin fell to the 100-week moving average. So is this area right here that area right there? I don't know. And again, I do feel somewhat torn. One of the other things you have to look at is if you look at ROI from the low for Bitcoin, right? If you just look at ROI from the bottom, or sorry, that's the wrong one. If you look at ROI from the cycle bottom for Bitcoin, it's where it normally is at this point in the cycle, right? So that's also something you have to consider. With that said, last cycle got ahead of the prior cycle, and then eventually it went below it. So you could always get a sell-off after the first rate cut where Bitcoin ends up going below the ROI from the last cycle. It ends up over here And it still could be somewhat similar. Again, if you take Bitcoin's ROI after the cycle peak, it is still ahead of schedule. As crazy as that sounds. It goes to show you just how far ahead Bitcoin got this cycle. But peak to peak, Bitcoin's still ahead of where it was in the last 2 cycles at this point in the cycle. It's fascinating. So even if you did get a drop after the first rate cut, right? Even then, so what? What if it just drops down to where it was last cycle at that time? Possible. The other thing, ETH Bitcoin, right? 0.04082. What did I say? I've said this for years and years and years. In the end, even the giants will fall. And I've said before, the bottom for ETH Bitcoin, in my opinion, is between 0.03 to 0.04. It already went to 0.04. It's possible that's the low. But you have to remember, last cycle, ETH Bitcoin did not bottom until after the Fed cut rates and once the Fed pivoted from QT to QE. So a lot of people are probably interested in whether the Fed's going to cut 25 basis points or 50 basis points next week. I don't really care, honestly. What I'm more interested in, what do they do about their balance sheet? Do they continue reducing the size of their balance sheet? Or do they stop and start expanding it? That's what I think is going to be more important to hear what they have to say. Because it wasn't until that pivot that ETH Bitcoin bottomed. It wasn't until that pivot that ETH Bitcoin actually bottomed out. Everything else before that was noise. Just like everything this cycle has been noise, right? Oh, this was the merge. Remember? This was the merge. This was the ETF, right? This was the Bitcoin ETF. Every single one of those things did not matter. It's not that it never will matter. It's just that it doesn't matter during a late business cycle environment. But you can see the narrative, right? I mean, you can see the merge, the Bitcoin ETF, going into the Bitcoin halving, the ETH ETF. Every single one of them was a lower high. Every single one. Even the merge was a lower high. I tried to convince people back then, and I got a lot of hate for doing so. But I wasn't wrong. A lot of people just don't have the patience to watch it play out. So this stuff was always going to play out, right? It was always going to play out just like it did last cycle, just like it did the cycle before that. My guess is that ETH Bitcoin is going to bottom out, somewhere over here and then go up in 2025. Okay? Base case is that it bounces sometime, before the end of the year and then goes back down and maybe puts in like a double bottom or something before going back up. But this stuff, I know it's complicated, but I think the more you look at it, the more it does make sense how the markets actually work. And I mean, you can see like Bitcoin dominance is going up, right? It's going up. Alt Bitcoin pairs, yeah, I'm still scratching my head on why they haven't capitulated yet. But I think in due time they will. Perhaps after everyone has given up on it actually happening, that's when alt Bitcoin pairs will finally go to their range low. So this is your monthly CPI report and how it affects Bitcoin, how it affects risk assets. We'll talk more about it later. And I mean, I know it's some of the things can be scary, especially when talking about the 1970s. I've said this before, right? Hope for the best, plan for the worst, right? It's not that I hope for that stuff to happen. What I hope to see inflation go back down to 2%. We get a landing, whether it's a soft landing or a hard landing, and then we just build it up from there, right? And I don't know how long it's going to take. Maybe it's already over with, but still seems like there's a lot of data that's going to be coming in over the next few months that's going to help dictate whether it's a soft landing or a hard landing. And also, it's going to be interesting to see how fast inflation falls. While it's good that inflation is falling, the bad part of inflation falling, which is kind of weird to say, like obviously everyone wants inflation to fall, but not everyone. But the bad part about inflation falling is that, if businesses can no longer just pass on higher and higher costs to their consumer, if they have to start reducing prices, that's going to hit their bottom line. That could impact earnings. If earnings get impacted, that could affect the labor market. That could lead to layoffs. And then it could just be like sort of a downward spiral, right? So there are risks to inflation dropping too quickly, even though I think everyone here would like to see inflation drop. Anyways, we'll wrap it up there. Thank you guys for tuning in. Make sure you subscribe, give the video a thumbs up. And again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. That sale is going to end by the end of the weekend. I'll see you guys next time. Bye.